Hey everybody, Real Estate Ninja here. I hope you're doing well. One bank may not be doing well, and that is Valley National Bank. The reason why I say it is because they're loaded up on commercial real estate as far as the exposure in their loan portfolio, and they are that name starting to revolve around in the news. I want to share a story with you, and this is out of Market Insider. It's entitled Banks with High Commercial Real Estate Loan Exposure in the Regulatory Spotlight, Valley National Bancorp, and 15 others to watch. We're going to go over this story real quick. And I want you to understand this stock was sitting at around $11.25 a couple of months ago. It's now in the eights. It's also been a part of this New York Bancorp, New York bank that's been coming down in price. It's having all kinds of problems. But it's not just that bank. And now this bank, Valley National Bancorp, is in the spotlight. And as more people start to figure things out and see where these companies are, these banks are with their exposure to commercial real estate, people start pulling money out of their banks. People start selling their stocks. The bank in and of itself may be doing all right. Here's the problem. As the stock sells off and there are more eyes on that company, they have a hard time grabbing extra money, borrowing money, things like that. And it becomes sort of a self-fulfilling prophecy, even if some banks are healthy. Okay. The reason why I'm covering this is because it's picking up in the mainstream press. I'm like, okay, this is probably going to be something in the next month or so. So let's check this out. Let's see what happens. It says more than a dozen banks in the US find themselves under the keen eye of financial watchdogs due to their sizable portfolios of commercial real estate loans. The Federal Reserve Deposit Insurance Corp and the Office of the Comptroller of the Currency jointly indicated their intent to scrutinize banks with CRE loan portfolios exceeding triple their capital and with growth that has exceeded 50% over the past 3 years. New York Community Bancorp, on the NYSE, its ticker is NYCB, is not among institutions deserving increased scrutiny, despite having a CRE loan to total capital ratio of 462%. So I want you to think about this. They're saying right here, this is not one of the banks deserving of increased scrutiny, despite having commercial loan to total capital ratio of 462%, surpassing the regulatory concern threshold of 3%. So the regulatory threshold, it's blown past it, but don't worry, you don't need to be concerned. I think this is going to be a really interesting video, and I think it's going to age very well over the next 60 to 90 days. NYCB's portfolio growth of 25% over the past 5 years keeps it below the critical 50% growth threshold that watchdogs find alarming. It's interesting how they talk about like one of their thresholds are the growth over the last few years, right? A percentage. You know how many watchdogs are completely wrong all of the time? How many of the watchdogs said a long time ago, or let's say 2 Novembers ago, as a matter of fact, would be a good time. You know what? We think that the regional banks are going to be in trouble. Now, I can guarantee you none of those watchdogs, they were all sleeping because they were too full because they had a big meal the night before and fell asleep. All right. It's just funny how, the media tries to throw spins on everything, but we all know which direction this is going. Now, it says here, this distinction is particularly noteworthy in light of NYCB's recent underperformance and increased investor scrutiny following a lackluster earnings report earlier this month. Regional banks that are under the microscope, Bloomberg analysis of federal data spanning over 350 bank holding companies highlighted that numerous small lenders have attracted increased regulatory scrutiny. This is because they've rapidly built up significant, large concentrations in their commercial real estate portfolios in recent years. Now, Valley National Bancorp is identified as the largest institution that fits the criteria for heightened regulatory examination with a staggering 80% growth in CRE loans over the past 3 years. An exposure that continues or constitutes 471% of its total capital. Alongside Valley National, other banks such as Home Street, First Foundation, Dime Community, Bridgewater Bank Shares, Hometown Financial Group, Axios Financial, Ocean First Financial, Bank Shares Incorporated, Chimung Financial Corp, Watford City, Savista Bank Shares, BCI Financial Group, Veritex Holdings, Service First Bank Shares, Independent Bank Corp, Southern Missouri Bank Corp, QCR Holdings, and Enterprise Bank Corp are all slated for closer inspections by regulators. You know, when this happens, and let me know down below if you're a part of any of these banks, when the regulators start moving in and sniffing around, they're usually going to, when they smell smoke, find fire. And that's exactly what happened during the Great Recession, right before. Now, market reactions. Despite the regulatory cloud hanging over these institutions, the broader regional bank industry, as monitored by the SPDR S&P Regional Banking ETF, witnessed a 2.4% uptick on Thursday. Well, that doesn't matter because upticks happen all the time during a crash. This surge is attributed to a confluence of factors, including some positive news derived from the latest 13F filings and the market anticipation of Federal Reserve rate cuts. Again, they are banking the Federal Reserve is going to cut rates. There's never been a time in history where the Fed has cut rates when things are doing well. They only cut rates when things are doing really poorly. There's no reason. Think about this. Why is there a reason for the Federal Reserve to lower rates when things are working out well, when things are going good, when the economy is chugging along? The Federal Reserve and banks love taking your money through inflation. It's a hidden tax. It's a secret tax that most people just don't understand. And so if you have higher rates, that actually adds to inflation. That's one of the factors of inflation. That's stealing. They love to do that. So why would they lower it? They would only lower it to spur growth because things are crashing. That is the only reason they ever do it, unless there's a couple times where it's politically motivated, but it's on the way up of higher rates. I believe that you're going to see in the next handful of weeks, banks like Valley National Bancorp start to take even more hits on their stock. Even if there's nothing wrong with the bank, there are so many people that are so aware of what's going on in the banking industry right now that they are going, all right, something's got to give. We're going to sell off some stock, or we're going to pull back in our exposure to these companies in any form. And you're going to see continued weakness. And I think that continued weakness is going to continue with the regulators. And they're going to start going, hey, you know what? Something's going on here. They're going to start digging deeper. And we're going to go into a bigger regional banking crash in 2024 than we saw in 2023. Hey, I hope you got something out of this. Thank you so much. Put it down in the comments below if you're part of any of these banks that were listed in the 15. I hope you guys have a great day. The real estate ninja is out.